Hello everyone, happy Sunday, welcome back. Let's get an audio check here on my end and we'll get right into it. Hello everyone, happy Sunday, welcome back. Alrighty, good to go. Glad to be here with you guys. New week, second week of December, closing out the new year, closing out this year, going into the new year of 2026. And what we'll be sharing here is analysis going into the close of the year and what I'll be looking at going into the new year of 2026. Everything we discussed last week was absolutely dead on, and it is. I was just thinking about actually before I started the live session here. Funds, banks, institutions, they're all thinking Saturday and Sunday, stressing. Where are these markets going this week? NASDAQ, S&P, dollar, they're all concerned. These big wig all professionals, right? Getting paid, six figures above. And they're all concerned with where these markets are going next week. And we're just here sorting it out with ICT concepts on YouTube. So beautiful stuff. So let's go and get into it, guys. We're going to start as always with the US dollar bonds, go into indices, and maybe I'll take a few questions here at the end if there's some good ones I like. Don't want to spend too long here today. Got some things to get taken care of. Williams, good afternoon to you, sir. Temp, Johnson, hello, hello. All right, guys, let's go ahead and get into it. We'll start with the dollar, and then we'll go into NASDAQ and S&P. All right, so we'll start from the monthly time frame here. All right, so we've been talking about dollar as it relates to higher time frame, monthly, weekly. We've been in a consolidation here, back and forth. Of course, we can still go into lower time frame like a daily chart, 4 hours, still sort out every single week what we're looking for, but just keeping in mind we are in an overall consolidation here. What I was looking at the last few weeks or so was how we traded above this high here. We got above the high, failed to accelerate and really run through it. So now we're pulling back into the range, which is not what you want to see if we're to see continued bullishness. So just something to keep in mind here. In November, took out this monthly high, broke back down, and now we're seeing weakness here on the monthly candle. One of the things I am considering, if we fail to get back up into this fair value gap here and we don't really see a retrace, then we could see another leg down for dollar. And that other leg down could take us down to the 88s. And then this would be like the consolidation at the halfway point from this high down to this low. So if we consolidate and start to break lower from here, then this will be the consolidation at 50% of the implied dealing range. Those of you guys that have been with me for a while know exactly what we're looking at there. So working right down into the weekly chart here. So last week we were bearish, so obviously no surprise that they delivered a bearish weekly candle. So we opened, created the high, priced in the high, broke down, took out the swing low that we were looking for last week as our draw on liquidity. So beautiful delivery of what we saw last week. Now going into the new week, I want to see if we continue selling off. Like I said, we took out this high back here, which we had as an upside target when we were bullish. But now after taking out that high, we failed to keep accelerating and making ground on the upside. Instead, we broke down. And again, that's what allowed us to quickly pivot and be flexible and look for lower prices. So from here, we have, nothing on the weekly. We'll just refine it down to the daily chart here. And that's a fair value gap and breaker block, but don't want to confuse you guys, so we'll just talk about the fair value gap here. All right, so last week, this is Monday's trading. On Friday, we opened, traded higher, hit the inversion fair value gap, and stayed in the lower half. That was a really easy insight, indication that the market was going to run into that low. Easy little drop into sell side here. And what that is that is the low risk sell of a market maker sell model. So ran up, took the buy stops. Smart money reversal occurring on the turtle soup. Smart money reversal is always going to occur on a liquidity run. So liquidity taken out here. We broke down through the inversion fair value gap. And basically what I gave you guys last week for free was the low risk sell of a market maker sell model, which would be here. Reason being, and I'll cover this when we get into indices. Again, the smart money reversal is always going to be the liquidity run. That's where the market's always going to reverse at some measure of liquidity. The low risk sell is the next entry that forms after that, which will always be, generally, if there is an inversion fair value gap, it'll always be the inversion fair value gap that creates the liquidity run. So if we're bearish, we expect this to be what? A turtle soup here, break down, work lower, right? Well, if you understand the market maker model components, once the turtle soup happens, the low risk sell is the next entry. And that low risk sell will be created on the fair value gap that ran liquidity. So this fair value gap here, you see how it was used to run the liquidity here? That's an inversion fair value gap every single time on the sell side of the curve. So it was really easy for me to give you guys last week again the low risk sell here in the market maker sell model, and then for the market to drop down into this low here. So getting more advanced, getting more technical with you guys Those of you guys that have been with me all year, you guys are on point. So looking at this here, inversion fair value gap sent us lower, very nice, cleared out the low that we were looking for last week, beautiful. And then on Friday, we trade up into this daily fair value gap here. For us to remain bearish, for us to see the first stage of distribution and see this thing keep working lower, we have to respect this daily fair value gap here. So if we stay below it, that's bearish. And then my attention is to the next daily sell side liquidity pool here. And then the next draw we would have if we accelerate through that would be measuring this wick here on the downside, then ultimately the low. If we accelerate through this low here and stay below this daily fair value gap. If we get above the daily fair value gap, that does change things for me, and then I'll just be neutral to, well, just neutral, because also considering that we're going into the last portion of the year, so that will also have an effect on price action, which can many times be consolidation into the close of the year. So these are the levels I'm watching. This is what we're looking for going into the week, which is just a continuation of the analysis we had last week, which is just bearish institutional order flow. Pretty simple stuff. Alrighty, so looking at the 4-hour chart now, we talked about all these things last week here. These are all annotations that I had on from our last discussion. So you see 4-hour fair value gap, we hit that, left it open, telling you it's bearish, breakaway gap, came back up into that daily inversion fair value gap here, stayed in lower half, easy money, lower prices. And then they left these relative equal lows here on Monday. Tuesday retracement back into the gap and then plummeting down into the retail support. So what I'll be looking at here on the 4-hour chart, as long as we stay below this daily red rectangle here and then we puke over, I want to see us run out the sell side here. Hourly chart, not much more detail than the 4-hour. It's basically the same thing. So on the hourly chart, the slowdown here is of interest, again, as long as we stay below this daily fair value gap, which is the red rectangle. All right, so the only thing that's kind of like a rock in the shoe here is we are seeing lower dollar. However, we're also seeing lower bonds. What the fuck? These are the classic market conditions we've been in this year, right? We have bonds moving in the direction of the dollar, all types of craziness. So what I'm doing, because generally, right, if dollar's bearish, we want to see bonds trade higher, right? It goes without being said. So the fact that we're seeing weaker dollar and weaker bonds is interesting. I'm going to cut right to the chase and look at what the order flow and what the candlesticks are telling me, because as of right now, I'm not going to try to be bullish dollar when obviously the institutional order flow is heavy. So interesting markets right now. Do keep in mind though, looking at the monthly chart, bonds are in this longer term consolidation. So do keep in mind, we are in a long-term consolidation for bonds. So at the end of the day, you know, the dollar can still do whatever it is that it's looking to do here. If you guys remember, I mean, yeah, we have been consolidating, but more specifically, I took our attention to, we'll look at the 30-year here. So we can see for the most part, the 10-year here, and then the, what is this, the 5-year? Yeah. So the 10-year and the 5-year have just been consolidating sideways, right? You can see that very clearly. The 30-year has been significantly weaker. So we see the 30-year has, and it's also been much cleaner. So this daily fair value gap we were watching, and in case you're wondering, is the bond market rigged too? They all are. Daily fair value gap trades up into it, stops perfectly at the midpoint here. That's how you know it's rigged. And it's exactly what we wanted to see, because we were watching this daily fair value gap here, wanted to see how we traded there, hits it, stays in the lower half, and then from there we're rolling over to attack the relative equal lows. The only thing that's cause for concern is the fact that we're not seeing the same acceleration lower on the 10-year and the 5-year. So if we can get the 10-year and the 5-year to break, then we will see continued lower prices. Now we're on the sell side of the curve of the market maker sell model for the bond market. So looking for lower bonds. Dollar's bearish right now. Just gonna have to deal with it, and we'll see what we get as we proceed forward. So I know a lot of you guys, especially membership guys, are gonna be asking me, well, what do we do now with bonds bearish? Just gonna have to see what they give us and take it candle by candle. Meaning, what's dollar telling you right now? It's bearish. Don't fight that, right? Don't fight that. Don't just say, oh, well, bonds are lower as well, so dollar can't possibly go lower. You'll get smoked doing that kind of shit. So take what the market is giving you, which is lower prices in dollar. Keep it simple. Alrighty, for NASDAQ here, $1 million question. So if you guys remember, last week, we talked about how the market dropped down into this gray pool here, which is where the 2 wicks overlap. That creates like a fair value gap in and of itself. Hits it, we rallied, and now we're seeing bullishness for the month of December. What I'm interested to see is if we've priced in the low of the month here, and we're going to continue expanding higher on the monthly for NASDAQ. Working down into the weekly chart here. Let me take this off. This should just be on the daily. So on the weekly chart here, we talked about a couple weeks ago how we dropped down and we took out this low here. So that's what sell stops. Smart money's going to buy that. And then we saw a nice projection to the upside. We were bullish last week, also partly because we're bearish dollar. So you see how the ebb and flow of the market, beautiful precision, lower dollar, higher equities. So last week we talked about higher prices for NASDAQ. We opened, drop, made the low of the week inside this bullish order block, which we also discussed last week as well. And then we saw classic open, low, high close in a bullish week when we're looking for higher prices. And then if you guys saw on Friday, they also gave that TGIF retracement, which all that means is once targets are delivered going into Friday, the market can pull back into 20 to 30% of the weekly candlestick for NASDAQ. And you see we delivered that very nicely. And I'll actually show you guys on the lower time frames. You guys will be able to see that. Let me take this off real quick. So you guys can see the TGIF retracement made the high of the week, pulls back into 20 to 30% of the weekly range, and then we consolidate. Make sure you guys write this down. When do you stop trading for the week? This is gambling, amateur hour, retail rec trading in here. Now, the way we can see that, the way we have the visibility to know the market's going to consolidate is what has the week already done. It's already seen its open. It's already priced in the low. It's already delivered targets, and then it's already pulled back off the high. So if you look at the weekly candle through this perspective here, we have the open, right? It's likely going to price in a low, and then we'll have the high, and then we'll expect the market to close off that high. Okay? So we're looking at a weekly candlestick here. So we've already seen the open, low, high, and then the retracement closing off the high. So what else is there for the market to do once it does TGIF? Absolutely nothing. And this is where accounts are going to be grinded down. But it's very easy to know when you understand the underlying components of how the market is delivered. So if you're blowing accounts on Fridays, this is how you stop. Alrighty, moving right along. Let's go back up to the higher time frame here. All right, so looking at the daily, well, here, we'll go back to the weekly. So weekly chart, bullish week last week. I want to see that continue into this week, especially given that we closed above this level here. Wait, let me actually go back. Okay, there we go. So yeah, so we got above this here, which is a balanced price range. That's why I have BPR. This is a balanced price range. We got above that last week, so that is bullish for me. So I want to see the next weekly candle open, stay above this, and then rally to attack the high here. Looking at the daily chart here, easy price run last week, just looking for the market to move from a discount market up to a premium. We're also in a market maker buy model here. So last week, there was two primary things we were watching, one of which was this inversion gap here, which I just put the Fibonacci on. All right, guys, 1 second here. Sorry, guys, house full of animals. Cats making noise on the other side of the door. It sounds like they're breaking the damn house down. All right, so last week we were watching this inversion fair value gap here. Now I want to show you guys the details here as to what you're looking for in price action, right? So inversion fair value gap here, we said the market needs to stay above that, more specifically in the upper half, right? So looking at this week here, we open on Monday, look at the bodies here, how they stay in the upper half. What is that telling smart money? People that know what the hell they're looking at, like myself, like you, and obviously the smart money entities, that's telling them it's bullish, right? Now, taking it one step further, we have this fair value gap here. If we're bullish, obviously gap should support price, but we're not, dollar menu mentorship here, right? So we look deeper into these gaps and not just say, okay, they're going to support price, but we want to see something very specific, which is we want to see the market do what? Stay in the upper half of the fair value gap. It does. Hits it, stays in the upper half. That gives institutional order flow entry drill, which is just a partial entry into a gap here. And then from there, we see the market rally and get above this balanced price range here. You're probably wondering, why is that a balanced price range? Good question. So this was a gap here before. You see that? We've then offered both sides, lower, higher, and then we left that range. So then you see how it stops there? On a dime, it turns with the bodies here. Open, hits it once more, hits it like a brick wall and turns. That's what you expect in a balanced price range. That's how it's going to act. And that's what told us we were bearish. So when we were bearish, the balanced price range was what? A premium array to send us lower. When we're down here and we're bullish, it's a premium array for the market to want to trade up into. See that? So now that we're above it, I want to see it act as a discount array. So discount arrays for this week that I'm going to be using is this balanced price range. I want to see the market stay below that, or sorry, rather stay above it, as well as this mitigation block here. This isn't a breaker because it's so stretched out in the price run, so this is a mitigation block for me. So key discount arrays for this week for me are going to be this daily balanced price range as well as this daily mitigation block here. We need to stay above that. We shouldn't get below that if we're going to remain bullish. Premium arrays that I'm going to be targeting in this market maker buy model is going to be this daily fair value gap here. If we get to and through that, get above it, next premium array will be the rejection block here, which is the highest close. And then if we see animation through that, then we could get into the high here to clear out the original consolidation that would be up here in the market maker buy model. Now, you can more clearly see this on the 12-hour chart. So this is the smart money reversal, right? Well, obviously it's a market maker buy model, right? This is the sell side of the curve. Smart money reversal, as I covered on dollar, will always occur on a liquidity rate. So liquidity rate adhere. That's the smart money reversal. The low risk buy will occur on the fair value gap that runs out the liquidity. So whenever you're looking at the turtle soup, the fair value gap that's created, if there is one, on the run lower that takes out the liquidity that is the turtle soup, that fair value gap is always the inversion fair value gap. That's how I was able to map that out for you guys last week for dollar, and that's how I was able to map out the bullishness for you guys this week in indices, understanding the inner workings of the market. So this is a key fair value gap here. Well, why this one, Dylan? Why not this one here, this one here, this one here? Well, this is the one that runs liquidity when we're expecting it to reverse here. So this is the smart money reversal that's happening after the liquidity is taken. And then this is the low risk buy in here. Why? Because it's the inversion fair value gap that took liquidity. So the low risk buy is always going to be, again, either the inversion fair value gap that runs out liquidity, or it's going to be the first fair value gap that forms after the liquidity is taken. So you see, in this case, both formed, right? Because now we have this fair value gap here. So you see the low risk buy here formed in both of them, right? Traditional fair value gap, the first one that forms after the liquidity rate here, and also the inversion fair value gap. So this is the low risk buy in the market maker model. What I gave you guys last week was the first stage accumulation, which is drop down, accumulate inside the bullish breaker here, low, lower, low. This is the bullish breaker and the fair value gap. So hits the fair value gap, hits the breaker, rallies, and that's the first stage of accumulation. Now what I'm interested to see is the second stage accumulation take place here inside the balanced price range. And then we see second stage accumulation run out the original consolidation. So that's what we're looking for here going into the remainder of the month of December. However, do keep in mind though, for market maker models, we do not need them to clear out the original consolidation. That is not necessary. All that is necessary is measuring the high down to the low. And this was a good gem that he dropped not too long ago, actually. So we need not the market always clear out the original consolidation in a market maker buy model. It just needs to get to the 0.75 or the optimal trade entry. So from where we were last week down here to here, that's enough. And now it's just simply trade management. You wouldn't be adding new long positions here from a swing trading standpoint. Obviously, from a day trading, scalping standpoint, you can do all types of stuff with this. But from a swing trading or even a short-term trading standpoint, your long positions need to occur here at equilibrium, not above it. This is chasing price and a premium, right? That's not what we're doing at all. So looking at this here, first stage accumulation, running out the highs here. And now what I want to see is, do we stay above this balanced price range here? If we stay above that, then again, that'll take us into the above levels that we're going to be looking for. Alrighty, working all the way down into the hourly chart here, giving you guys some insight on the market maker components here. Let me take all that off because I don't need this stuff on my charts. It's just more to show you guys what's going on inside my mind. All right, so looking at this here, let me drag this over so you guys can see what it is. So this is that balanced price range here on the daily chart. You guys can see how the market is using it this week. It consolidated inside of it, but now we're above it. So I want to see, do we use it as support here? You see the wicks trading inside of it, but the body's staying above. That's good. So what I want to see is, do we continue higher from here, which is what I favor. We have this daily fair, again, I already gave you the premium arrays I'll be working with on the daily chart, which we have here, the daily fair value gap, daily rejection block, and then the ultimate daily high back here. And that's only, again, true as long as we stay above this balanced price range here. If we lose this balanced price range, then I am neutral to possibly bearish, because obviously these lows here, you know, if it does break structure, then we could want to work lower. But as of right now, order flow, market structure is all on a bullish basis right now. So that is NASDAQ, S&P. Yeah, same thing for ES. So ES did take out this high here, which NASDAQ also did. So this high is taken out. I want to see us run through that. Like, I don't like to see how we took out the high and we're already starting to pull back down to the range. It needs to really aggressively run through that if we're going to see continued strength for indices. All right, so those are the usual suspects here. Make sure I'm not missing anything. All right, so I'll touch on the usual ones that you guys want me to look at, and if there's any other questions, I will touch on them here. Hey, Creative, what's up, man? All right, so looking at the weekly here for Bitcoin, we'll look at BTC. Still watching this inversion gap here. You guys can see we've just been working, inside that range, higher and lower. On a daily chart here, no acceleration on the downside as of right now. So what I would focus on for US dollar, or sorry, for Bitcoin, if we continue seeing weaker dollar, then Bitcoin will trade up into its weekly fair value gap here at the at the 96s. So 96K is in order for Bitcoin. As long as we see weaker dollar and we see a little bit of lift on Bitcoin, that'll take us into this weekly fair value gap here. How we trade there will be key. If we obviously sell off, then we'll see that insight in the lower time frame market structure when we get there. Or if we're going to be bullish, then we'll also see that in the lower time frame market structure when we get there. So BTC, Ethereum's a lot weaker, or at least has been a lot weaker than Bitcoin. So we'll see if they're going to keep sending this thing lower here on the sell side of the curve, or if they've sunk it low enough and they're going to keep sending it higher. We'll just have to see what they want to do with it here. Looks like quantitative easing is back on, so we're going to see money printing out of this world, and obviously inflation as a result. So that'll be interesting to see as well. And that's also why, speaking of the usual markets here, that's also why we're seeing this crazy price action, more specifically in silver, all the way up to the 60s. Well, I don't know. No, stop just short of the 60s, almost to the 60s. And obviously gold's still on its tear to the upside. So lack of confidence in the financial system is obviously sending metals parabolic, which obviously isn't going to change at all if you understand the mechanics of how the financial system works. So that'll be interesting to see. Debts and deficits keep ballooning, and on the back of that, we're going to see metals rip into the new year. Can you guys imagine what the world looked like with silver in the hundreds? That'll be interesting to see when we get there. Alrighty, so euro, pound, yeah, same thing as dollar. Nothing much there. Alrighty, let me make sure here that's everything I wanted to run through. Yep. All right, so the only other matter here is economic calendar. Do keep in mind we do have FOMC on Wednesday. So I will mostly be probably focused Monday, Tuesday, and Thursday here, more specifically for my trading. So now with the analysis that we discussed here on the NASDAQ and dollar, you want to use the premium and discount arrays that I gave on the daily chart, because that's where the narrative is going to come from. And then you want to look at that in the context of your economic calendar, right? So when are the price runs likely to run? When is it likely to make the high or low of the week? And that insight is going to come from the economic calendar. So I already gave you the premium and discount arrays that the algorithm is going to use, which obviously I do every single week. But now taking it one step further, take those levels and see how the algorithm is going to use them intra-week with the economic calendar. When is it giving the price runs? When is it making the high or low of the week? And you guys will see a lot of repeating characteristics that's going to allow you guys to do the same, which is obviously the goal here. Non-stop. So for NASDAQ, what would second stage accumulation look like? So do you understand what second stage accumulation is? Honest question, because that'll tell me how much I need to explain contextually, or if I can just get right into it. I don't know if it's the delay on YouTube or what's going on. All right, well, I'll just take it from the beginning. I'll assume you don't understand market maker components, and just for everybody else to follow along as well. All right, so market maker components here. So we're on the buy side of the curve here, right? We've seen the smart money reversal. We've seen the low risk entry. We've seen first stage. And now the second stage is what comes after the first stage of accumulation. Well, Dylan, how do you know where accumulation is going to take place. That's what's so powerful about the market maker model components. There's no guesswork. Where did they distribute on the sell side of the curve? And where they distributed on the sell side of the curve, they're going to recapitalize that same order flow on the opposite side of the curve. Meaning, let's look at this here. Right. When the market is bearish here, right? You see how these three up close candles here, or like these up close candles here, you see how this is a bearish order block? Right, let me make that. Let's make this red so it really stands out. See, this is red here. All right. So these four up close candles on the sell side of the curve here, right? When it's bearish, when we were bearish, we were looking for this low down here. These four up close candles, that's a bearish order block, right? Up close candles, breaks below it, comes back up into it, hits it, acts as resistance, exactly what you'd expect, sells off, right? Same thing is happening here. Well, we could just look here. We use this range here. Same thing is happening here, right? Up close candle, hits it. That's a bearish order block on the sell side of the curve. So it's going to do what? Send price lower into the target, which again we had down here. Well, this is where they're selling into, right? That's why it's order block. They're selling into these up close candles. They're selling into these up close candles here, or they're distributing their positions, right? So market maker selling is taking place here. Market maker selling is taking place here, which is great. Well, now how's that helpful? That already happened. Well, that's a really good question. Well, how did I know the low of the week was going to form here? Ooh, extended through. So where distribution took place on the sell side of the curve, you're going to see new accumulation on the buy side of the curve take place there. So how do you know this is first stage accumulation? Well, they distributed here on the sell side of the curve, so they're going to accumulate here on the buy side of the curve. Well, let's extend this one over here too. My goodness. Where they distributed here on the sell side of the curve, they're going to further accumulate more on the buy side of the curve. So how do I know second stage accumulation is going to take place here? We'll look at the left side of the curve and match it up. And if it's going to clear out this high here, which it doesn't have to, but if it is, then the second stage accumulation will take place here. That's why I was saying on the daily chart here. This up close candle here is a mitigation block in my analysis. Reason being is because it was a bearish order block on the sell side of the curve, right? So you see how we hit it. Here's a bearish order block, sold off, hits it once more, sells off. So this is what? A bearish order block on the sell side of the curve. On the buy side of the curve, it'll become a bullish mitigation block, and we'll use it as support. So how do I know second stage accumulation is going to take place here? Because I'm matching it up with the left side of the curve. And if you study your market maker models long enough, you'll see that this is happening in every time frame on every single market, and it will absolutely, your ass will hit the floor when you see how consistent the market delivers with institutional order flow, market structure, market maker model components, and how all that comes together. And it is absolutely beautiful when you understand how to read the markets for what it's offering. Hopefully that answers your question on what would second stage accumulation look like. I wanted to give you the context, right? It wouldn't make any sense if I just said, yeah, look, this mitigation block is going to send us higher. What the hell does that mean? So hopefully that makes a little more sense for you. Kennedy, looking at the weekly on dollar. Thanks for the market maker model explanation. Yeah, pleasure. That is really what takes you to another level. So the highest form of trading smart money concepts is market maker models, because you have to understand everything else for it to make sense. Because if you don't understand the basics of how the market runs from, sell stops to buy stops, if you don't understand basic institutional order flow, if you don't understand the PD arrays, market maker models aren't going to do anything for you, right? But if you understand all those other components, then the highest form of trading is market maker model components. And Michael's even shared that as well, that it's his it's the closest to his actual trading. And I'll just leave it at that. Good stuff. All right, so Kennedy, looking at the weekly, it looks like the weekly candlestick closed outside the inversion. Yeah. That's also what's supporting my bear stance for dollar as well, for sure. Yep, we're on the same page there. PA last week was very high resistance to the upside, indicating a huge drop in the short term. To send price higher again. Yeah, could be, absolutely. And if that is the case for NASDAQ, playing devil's advocate here, saying, let's say they do want to sink it to send it higher, that's very possible. That's very possible. That's why I need to see the market stay above the balanced price range. Because if we start to make ground through that, then of course I'm gonna have to pivot and see, well, what are they gonna want to reach for if they're gonna take it lower? There's no inefficiency here, so there's the liquidity here. So if we do trade down below that, then these sell stops here become of interest. But based off everything we've talked about, how this is a balanced price range, it shouldn't get below that. So when you understand the relationship between efficient plus inefficient price ranges, that is going to give you a lot of clarity as to how institutional order flow should be delivered. So the reason I don't want to see that traded down through and below, if we're going to be higher longer term, is because of the basis of it being a balanced price range. But it could. And if it does start to work lower through this level here, the only thing that it would want to reach for is the liquidity here, because there's no inefficiencies here. Hey, Robert, what's up, man? Having a hard time getting a weekly bias. I appreciate the explanation. Thanks. Yeah, absolutely, man. Glad to be here, sir. And the cool thing is, with scalping and what it is we're doing on an intraday basis, I mean, the cool thing is, you can trade without a weekly and a daily bias as well. Just understanding, what liquidity pools it aiming for, what's the intraday target, waiting for the right times of day, getting in on it, and you don't even really need these higher time frame insights to scalp. Obviously, it's extremely helpful understanding where the higher time frame is going, and I'm not trying to take away the importance of that because, obviously it goes without being said that if you don't understand where the higher time frames are going, the lower time frames are probably going to be a lot more challenging for you. Glad it was insightful, sir. Alrighty, guys. So that's it for me here. We're going on about 1:30, so I'm going to go ahead and get going here. I will see you guys on the next one. Appreciate you guys joining. Appreciate you guys' good questions. Hopefully you guys were able to take something out of this one. And I will see you guys, I believe, on the next one. Do hit the like button on your way out if you guys learned something from this one. Would greatly appreciate it. And I will see you guys later on. Have an amazing rest of your weekend. Take care, everybody.